So there's this company, Aye Finance, and they want to be the bank for India's small businesses. A great mission, right? Well, they're about to go public, and on the surface, it looks like a story of just explosive growth. But if you look a little closer, you start to see some worrying cracks. So the big question is this a rocket ship you want to be on, or is it more like a house of cards? Let's figure it out.
And that quote right there is the exact problem iFinance is built to solve. They're lending money to the small businesses that are really the engine of India's economy. You know, the ones that are often completely ignored by the big traditional banks. We're talking about a massive, underserved market with absolutely incredible potential.
All right, so first up, who exactly is Aye Finance and what's the whole deal with their upcoming IPO? Let's get into it.
At its heart, Aye Finance is what's called an NBFC. Now, what does that mean? Basically, they're like a bank. They provide banking services, but they don't have the official bank license. Their real sweet spot, their focus, is on lending to all those micro, small, and medium businesses that the big banks often just turn away. You know, the local manufacturers, the traders, the service providers that are really the lifeblood of our economy.
Okay, here are the nuts and bolts of the IPO. They're looking to raise about 1,010 crore. Now, a big chunk of that, 710 crore, is a fresh issue. That's new money going straight into the company's pockets, which they'll use to fuel even more growth. The other 300 crore is an offer for sale, which is just where the existing investors get to cash out a piece of their stake. So what's the argument for Aye Finance? What's the story that's getting investors all excited? This is the bull case.
Now this is Anne's secret sauce. Instead of using old-school credit scores, they've got this really smart cluster-based model. What they do is they dive deep into specific business communities. Think of the shoemakers in Agra or the toy makers in Channapatna. They learn everything about their unique cash flows and margins. This kind of industry-specific knowledge, it's a huge competitive advantage. And it makes it really, really hard for anyone else to just come in and copy their model.
And that secret sauce is backed by a really solid business. I mean, they're all over India with a massive footprint of branches, which means they're not too exposed to problems in any one region. And they have this physital model. It's a clever mix of physical, on-the-ground branches and slick digital tech. It helps them grow super fast without losing that personal touch with their customers.
And honestly, the results kind of speak for themselves. Their assets under management, or AUM, has more than doubled in just a couple of years. We're talking from around 2,700 crores to over 5,500 crores. Now that is the kind of explosive growth that really gets investors to sit up and pay attention. But, and this is a big but, here's where the story gets a lot more complicated. It seems that all of this explosive growth might just have a dark side. So let's flip the coin and take a hard look at the red flags.
So here it is, the big question. Is Aye Finance growing too fast? Because while their loan book is getting bigger and bigger, the quality of those loans seems to be getting worse. Is this just the price you pay for doing business in a riskier market, or is it a sign of something much more worrying?
Let's just follow the numbers. Back in fiscal year 2023, their gross non-performing assets, which is just a fancy term for bad loans, stood at 2.49%. You know, not fantastic, but for this line of work, it's pretty manageable.
But then watch what happens. Fast forward to fiscal year 2025, and that number has shot up, almost doubling to 4.21%. You can start to see a trend forming here, and it is not a pretty one. And yeah, it gets worse. The latest data we have from September of 2025 shows it's climbed even higher, to 4.85%. The steady, relentless upward climb in bad loans is the single biggest flashing red light for anyone looking at this company. I mean, it's such a clear, undeniable trend. As one analyst put it very simply, this graph of NPAs is going up. And believe me, in the lending business, that is the very last direction you ever want to see that graph moving.
And there's more to it. I mean, by definition, their customers are risky. On top of that, a huge chunk of their loans, almost 40%, are unsecured. That means if a borrower defaults, there's no house or car to seize to get the money back. And of course, you've always got the market risk of changing interest rates, which can squeeze their profits. It's a very tricky business to be in.
All right, so with all that in mind, how does Aye Finance actually stack up against its rivals, the ones who are already trading on the stock market? Let's put them head to head. So here's how they compare. They're not the biggest player out there, and they're not the most profitable either. Their return on net worth is decent, sure, but it's lagging behind the market leader, 5-star. And its valuation, that PE ratio, it seems fair, but it's not exactly a bargain.
They're kind of a solid, middle-of-the-pack player. So the question for you is that enough to get you excited?
So what's the bottom line here? It really all boils down to that classic investor's dilemma. It's all about growth versus risk.
On the one hand, you've got this super fast-growing company with a really smart business model, and it's targeting a massive, untapped market. That's the opportunity. But on the other hand, you have a company with a very clear and very much growing problem with bad loans, and that is the risk.
So that leaves us with the ultimate question. Can Aye Finance keep growing like a weed without letting these bad loans completely get out of control? That is the high wire act they're performing right now, and it's really up to you to decide if you want to join them up there.